And now, everyone, the Beatles. Just kidding. How's everyone doing today? Hello, Warriors. I almost said action junkies. How's everyone doing today? I want to welcome our viewers from investing.com. We do cover stock indexes, and I have some ideas I want to share with you. I want to start off with our Bailey Wick, which is $1. We blogged about it. You should go to our blog and read about it. Talked about this, I believe it was last Thursday, when a market tests a breakout area multiple times. It's not because the market is being accommodative to you and gives you 1, 2, 3, 4, 5, 6, 7, 8 chances to buy a breakout from this level that you need to be skeptical. And we had our breakdown and follow through in earnest yesterday. So to me, this is most likely headed towards the 94 handle, maybe a little bit under it. And this is the weekly on it. So, have some important moving averages here. And then after that, that's going to really be the line in the sand. We break through that, we have 92, but right now I'm thinking we're going to hold in this range, probably finish off this decline into the end of the month around 94. And how could we get up here? Which is what I think could happen sometime before the spring. And there's something called the February break that takes place in the commodity markets. And I think since stock indexes are commoditized, that we could have the flush out. So what could be the event? The market event that could drive us from here to new highs, I believe, is going to be that this bottom in the S&Ps is a temporary bottom, and that we're going to get one more flush under the 23 handle here. So how could this unfold? I'm thinking that this may have been ABC for A. I know a lot of people, this was a great area. A lot of people were hoping back here that they'd have a chance to short the market up to 2,600. I'm open to the possibility that this is just the first wave, and now we're going to correct this wave in a B. I don't know how deep it's going to be. And then we get one more move up for a C before the sell-off occurs, maybe shake out some people up here around 2640 to 61.8, 2708. So anyway, I don't think the initial break is going to take us back to new lows, although I think it's going to be taken out. I think we're going to unfold into a pullback, some type of high or low, at least above here. And then one more rally attempt. You think that could probably complete by the end of the month. So everyone's going to feel pretty good about it January. So what could be the catalyst for the market selling off in February? We get closer to the trade tariff war with China, only having a month to go. We have a Fed meeting in March, and right now the market is thinking that the Fed's going to do nothing. Maybe one tighten this year, late in the year. So the market is very positioned for a very dovish Fed. We know how the tune has changed, maybe at new highs, that were, the market's in much better shape. Maybe the Fed changes its mind again. There could be many catalysts, but the main theme is that this rally in the S&Ps eventually is going to peak, and that to complete this, we need one more flush under 2,300. And if that happens, dollar gets bid on a safe haven, maybe from down here, and really surprises a lot of people. I think a lot of people think this is a major top, and we're headed sharply lower. I mean, there are a lot of people talking about that we're going to retrace the whole move back to 88. I think that there's potentially one more shot up in the S&Ps. I want to just cover the gold briefly because we're almost, we tagged previous highs. So we were talking about that there could be one more push up in the shiny yellow stuff. Very good week after trying to reverse last week, inside week. So maybe it happens next week. And Why can't we just tag this trend line again up here? Looks like it's going to come in around 1305 or so. Similar situation with silver. Maybe we get one more high as the dollar is pulling back towards 94-ish. You know, we head up towards 16, but the gold is pretty clean to me. I'm not saying it's the end of you know, this type of intermediate term trend, but maybe from here, then we get the pullback to 1250, which is going to be an important line in the sand. Everyone with me? You'll get better. You will get better. In fact, you know how to get better, Zig, and you discovered this quite some time ago. But you get better by immersing yourself in this community. And right now, there's a sale. Okay, so there's a nice sale. We do pretty good discounts twice a year. Probably won't see anything until the summer after this. I recommend at a minimum the 6-month plan because I don't think you could judge us or anyone else on a monthly plan, but that is better than nothing. So you have till the 18th to decide. I like, you know, doing it. I recommend doing it on like a Friday, like tomorrow. And then you have the weekend to learn how to navigate around the site. You know, you learn how to use the dashboard, how to get all the different types of analysis. You get Elliott Wave. You get Amanda in the private members chat. Okay, so this is how you immerse yourself into the community. Members chat, you're going to be on the Jumbotron in a minute. But see, this happens all day long. We have lots of traders that trade for a living in here that share their ideas and their views. Amanda moderates the chat. She is a fantastic trader. So you can see how active she is. And everyone shares their trades in here. So this is part of the package of being a subscriber. Another important package is what happens 3 hours before face. And that's going to be Paul Franco in the European crossover at he gets up at 1 in the morning to service our European and Asian subscribers and members, and he does a great 1-hour show with all the key levels. He runs through a spreadsheet with all the majors and everything else we cover. So I have to say this, people, I tweeted this, that before I joined ForexAnalytix, so that's just my personal testimony, people thought and have said, and I thought I was, you know, I was good. I was okay. I'm better now. And I'm better now because I'm surrounded by our team during the webinars and have access to their research all the time. You know, you have really elite team members here. Let me go back to home so I could just show you who's part of this. Okay, and a lot of them are very well known on social media, on FX Street. We're contributors on FX Street. Look, we won an award. Look at that trophy. I know. Get your magnifying glass out. So most people, most people know Blake and Grega. When I was running LAR at FX Street, I interviewed Grega. He won an award for best, I believe, sell side analysis. Stelios worked for the biggest banks in the UK, trading many digits in LIBOR and other markets. Steve, I interviewed when I was on FX Street, but I didn't remember it. He reminded me that, but I'll tell you what I do remember is you're going to see the last at the bottom of the hour, someone give a breakdown of the board for free, sharing his ideas and what he's doing in the markets, that if you come in and you're unclear and fuzzy about what's going on, listen to Steve for a half an hour every day. And he's going to clear the fog up for you. There's Dale Pinkert. That's me. And Joe, you know, Joe is getting all kinds of attention on some great media, Bloomberg and Real Vision, Raoul Paul's publication. Paul Franco, as I mentioned earlier, you know, he worked with Blake at the other place, and Blake was very excited to have Paulie back with him and doing a great job in the European crossover. Amanda, you know, the longer I've seen and been around Amanda, what a great addition. She does a great job in members chat, and she's there many hours a day. And then we have our harmonics expert, Andre Cardoso, that I don't want to miss anytime I get a push alert about a new harmonic pattern developing by Andre. So you get, you know, all these different types of analysis and services, and it's really not hard to do. You just click sign up today. And let's see, today's the 10th. And I will say that you will grow, okay? You will grow spending 6 months immersed in this community. And then if you're not happy with your broker, you know, we have a reimbursement program. You go to the broker of brokers, and that's Forest Park FX, to Trent and Justin, and they'll find you a place where you could get rebates, either to get paid if you're in the US on rebates, or if you'd prefer and you're outside the US, you could use those rebates to pay for your subscription just through the normal process of you trading throughout the month. But if you're not getting either of those,
Dale,
you need, yeah, Blake.
Sorry, I hate to interrupt. Can you cover just like 2 more minutes? Thank you.
Yeah, no problem. Okay. So Trent and Justin, you could get a hold of them. They're our sponsors. They sponsor FACE, and they do a great job. They care about people, which is, you know, kind of unusual. You won't get phone prompts when you call them. You'll get a live human being talking to you guys. So Blake had some things he wants to get done, so let me take a look at a couple other things. Why don't we take a look at yield, because yields have a lot to do with what's going on in the markets here, and there are a couple different cases on the 10-year that I want to show you. So here's your 10-year yield chart. So this was, you know, risk off. This is risk on, right? So we've had the market bounce, and we've had yields pop, you know, 0.20, not bad. So like I was saying, and I think we'll get a similar play here in the bonds, where you're getting a pullback in bonds while we get a pullback in S&Ps. I don't think we're going right to new lows. I think that we could pull back and then have another one of these or even more, and yields could head up towards 290, 295 during maybe the rest of the month of January while the S&Ps still recover. And then we might have risk off again. And I know some people, the bullish case for bonds, you know, is that we could head at least to 220. And I've heard people even talk in a deflation cycle, maybe even back to 2. So we're going to be correcting this. You can say this closes back over 3.25, which was the high that we had several months ago. It's definitely going to lead towards higher rates, probably back towards a 4% 10-year yield. So we'll see if that happens with the market going up. Maybe both bonds, you know, we always look for the market down, bonds up, bonds down, yields up, market up. Maybe they both could be like right now. They're acting good together, and maybe after this is complete, before the S&Ps roll over again, they act bad together. So that's a view on that. That has implications for gold. You know, as yields head up, it's usually a bit negative in gold. It's usually positive US dollar yen. So yields are a very important part of what we trade, so pay attention to them. And, you know, that would be the case if we were really going to sink down here in yield. It lowers opportunity costs in gold, right? Because right now, you good, bro? Because a 2% yield with less than 2% inflation is, you know, basically you're getting zero on your money. So everyone's talking about tightening, but if inflation rate's 1.7 and you get a 2% yield, you're not getting paid much, pretty close to zero. So what's up, buddy? We finally got that breakout in euro.
We did. We did. And, you know, it's something that we had been anticipating. I picked up pretty big euro position. My average is at 115.10, and I'm sitting in it right now. It's just, it's, you know, it's holding the breakout point, which is good. And first of all, I want to apologize that usually it's really quiet around here at this time in the morning because it's well, it's 6 o'clock in the morning and it's still dark outside. But
you rooster.
Well, yeah, my dogs must have saw a
coyote.
No, probably a cat. It was that kind of, yeah. Just of course, just as I'm about ready to start broadcasting, but or you know, start talking. But anyway, so this is the euro dollar, and one thing about the euro is we got this rally and it broke above 115 as we had been expecting. And you know, I'm going to take you real quick. Let's go over to the blog on ForexAnalytix. If you guys don't check this out on a daily basis, there's a blog about showing you all the crosses that were showing the anticipation of the breakout of the euro. So you can see, you know, from, you know, the euro dollar, you know, poised to break out to the, you know, Aussie, okay, or no, this is the cable. Sorry, cable is right up against resistance. The Aussie, okay, the Kiwi, the Canadian, you know, showing further breakdown to the 50% retracement. They were all telling us that the euro dollar is going to basically break out.
Yeah, none of our.
What's that?
None of our members are surprised about the dollar action heading lower.
No,
we've been prepping them for a week.
Yeah, we have, and I mean, you know, the euro. Now the question is, what do you do right now? And my answer is, as long as we stay above 115, you have to be on the long side. So the reason why, I mean, we've got 2 months of a consolidation and remember, it wasn't like it was a consolidation in the summertime. It was a consolidation at the end of the year, which is typically the most volatile time in the currency market. So when you have this compressed volatility in the FX market, the now the momentum is shifted to, at this point, the upside. And one of the things that I've noticed just over the last 24 hours or so is the resiliency of the euro, despite the Aussie feeling a little top heavy, maybe the Kiwi feeling a little top heavy. The cable can't break above the 128 level. It doesn't matter. The euro is still above 115. And really, if the euro's to unlock higher prices towards 116 and 116 and a quarter, or 116.16, which is the 161% extension, or more importantly, I think the range extension, which is going to be 117 and change. The way we get up here is to see further dollar weakness elsewhere, and you're seeing it even in the dollar yen has stalled at the 109 level and is pulling back, and most traders feel that we will eventually revisit these levels again in the dollar yen. So the dollar yen should see 105. Now, does that mean that the dollar yen's going straight to 105 yet? Or now? No. And does that mean that the euro dollar is going straight to 117 today? No. I think it's going to take us a good several days, if not a week or two, to get the euro dollar back up towards 116, 117. But I think that is the path that we're on right now. Like I said, as long as we have daily closes above 115, we could, today we could slump and test the 115 level, but I think this is going to be an opportune level to get long. Now, I hope we don't get down there, because that's going to be below my cost average, but I'm not ruling it out at all. I think it is possible. Now, we were moved up in Asia above the 127% extension. I was thinking last night when we were sitting at 62, which was right here, and and I was about ready to go to sleep, and I'm like, I should probably pull a little bit off, but I didn't. I'm like, no, I'm going to stick with this. This is a long-term consolidation that is breaking out. I want to participate in this move. And so I'm, that's the reason why I stayed long. I had an order to buy. This is probably the most frustrating thing. You can, I don't even have it on my cancels anymore on JP Morgan. I had an order to buy my last bit of euro dollar at 115.17 and 0.3 of a pip. The low registered on FXCM at 0.7 of a pip, but I put in some pretty big orders. It's not, I'm not trading 10,000 in currency. I'm trading a lot more than that, and so my big order got missed. And this is not surprising to me that it got missed. They got missed by a half a pip, but we're continuing our uptrend, and I feel that these are, these dips, you want to use them as opportunities to be on the long side. So on the euro, if I had to draw it out for you guys, let me grab a pen here. What I would be looking for, you got this drop here, maybe type of consolidation like this, and right here may offer a better long opportunity. I don't think we're breaking higher today. I don't think we're going, breaking above these levels today. I may be wrong. I hope I'm wrong. And it's possible, but I don't think we are today. I think that you should get another dip to be on the long side of the euro. I'm thinking that that everybody's going to get an opportunity. One of the things that may stop the euro dollar from going lower is the euro yen. The euro yen I want to bring to your attention because this was our chart of the day from a couple of days ago, and it's extremely an important resistance that we're trading at is at 125. Now, if the euro dollar breaks above 125, we should be able to see 126, 127 rather quickly. I know I've said that on a couple of different occasions, and over the last couple of days, and I believe it. I think that if we break above 125, this is all, really big false breakdown here in the euro yen. That flush in Asia last Wednesday night, that could really, have stopped out a lot of traders and stopped out a lot of longs and got a lot of people short, and that could really start to squeeze higher. And one of the other things that you got to be looking at is the S&P. I mean, the S&P, we're nudged right up against key resistance. I see a lot of I've read of a lot of technicians and what they're looking for, and they were looking for this 2600 level to hold. Matter of fact, Joe, who was on Real Vision TV, like you had mentioned, Raoul Paul's network, he talked about, shorting the S&P at 2600. Well, if you shorted at 2600, you could have already made 30, 40, 30, 35 pips in the SPOOs, which is, not a small feat. I mean, that's a
day traders drool for that.
Yeah, I mean, if you would have taken Joe's recommendation from a couple of days ago and just shorted the S&P at 2600, I mean, you're up 20, 30 S&P points. That's a nice gain. But the point I want to make here is if it does break, because if it does break, I do believe that we'll see probably 670, 2800, or 2670, 2680 before moving lower. Now, the reason why is that's a big, broken trend line, that green one, big broken trend line, uptrend line, but it could be retested. So we could retest that neckline, at any point. So personally, I think if the euro yen breaks higher, then you're going to get that type of move. Damn, this euro does not want to pull back. It really, I'm kind of hoping it pulls back just because I want to be able to add to it. But I'm telling you guys, this has been a 2-month consolidation. You got 2 months of compression in what's typically a very volatile period that tends to yield a lot of upside, and we could really exceed my expectations here. And I know there are many dollar bulls out there, many dollar bulls, and let's go.
Fuel for the fire.
Yeah, many dollar bulls out there, and see this, the 38% retracement is just the range extension. But let's imagine for a moment this ends up being a longer term consolidation. When I say longer term, I'm going to do this.
Yeah.
Okay. Up to 120, back down to 115, back up to 119. But no, think about that. Think about what we've got here, right?
Yeah.
I mean, it's entirely possible, and for, if you think about what is happening here in the United States, there's a couple things coming to a head. We have an economy that was running hot towards the middle to Q3 of 2018. Data has started to get a little worse as of the last quarter, and it looks like the U.S. economy is now finally starting to level off, if not slow down. You've got a Fed that is at the end of its hiking cycle. You've got an administration that is hell-bent on building this wall at any cost, which is, we go into tomorrow, and this is going to be the first paycheck that 800,000 federal employees miss. And
Fitch is talking about a downgrade on our debt with this going on, Blake. That, that was a big event a few years ago.
Yeah, I mean, this is going to be the longest government shutdown in the history of government shutdowns.
I'm glad I work for you instead of the federal government, Blake.
Well, let's
you're always on time, man.
So, well, but let's imagine this though. You've got government workers, which, we're not in the private sector, guys. This is government, and I hate to say this, as some of you maybe work for your government wherever you are at, wherever you're located around the world. If you work for the state or for the government or for your for whoever, chances are you're not a highly paid employee, because there's not really such thing really as a high paid government employee. I mean, if you think about it, right, compared to the private sector, most of the government employees are paycheck to paycheck. So you have unless they start tapping into their pensions,
they're under duress, Blake. I've seen a lot of stories. They can't pay their rent. They have to decide between utilities and medicine.
Oh yeah, and with the IRS shutdown, how many home mortgages are going to get approved? Zero.
Oh yeah.
How many? Your housing market comes to a screeching halt. You can't process your refunds. So then people that want to buy their first time homes with their down payment, they can't get a down payment check. So now your housing market's is stuck. I mean, if this drags on, much further, it's going to be a real big drag on not only the dollar, but on the U.S. economy as a whole. And that's why I sent that tweet out yesterday. Like, hey, if you're listening to all these GOP senators come out of yesterday's meeting, trying to fall in line behind Trump on border security, that's a scary thing if you're a dollar long, because it looks like they drew their toe in the sand and they're not going to cross it. And so you're going to have this big, hopefully not too long, but possibly long drawn out fight in the U.S. government. So when I'm looking at the euro dollar and I go, well, is it possible for the euro to get to 120 or 121? Or it might be. It's not. I don't think it's necessarily out of the question at this point. But that's why I want to say that we may actually exceed my expectations of 117 and change, which is the range extension out of here. We could, if we end up being a longer term Initial jobless claims are a little bit lower, but that number is going to change, right? That number is going to change. So, we could end up being in a much longer term consolidation. You guys might be, dollar bulls, and ultimately may be right, later this year, if we eventually break down. But for right now, you got to be really, really careful with the dollar. And I had some, I had a little bit of fun on Twitter yesterday, Coach. I said, the lack of retweets of my euro dollar breaking out chart suggests that the retail community is short euros. Right. That wasn't a joke. That wasn't a joke because I don't know how many followers I have on Twitter. I've got 50,000 maybe.
A lot.
Yeah, I got they're all organic. I've been on Twitter for 10 years. Let's see. I've got
normally 50. What kind of reaction would you get on a tweet?
Oh, if it's a good chart that breaks out, I can tell. I'll get 40 retweets on a good, solid breakout. Yesterday was a solid chart breaking out, and I got like 3 retweets. Now,
because they were
if you go look now, there's like 11 or so or something. I saw it this morning, but that lack of retweets means that because people want to push their own positions, right? They're like, oh yeah, I'm long the euro. That's a great chart. Then they'll retweet me, right? And when there are no retweets, and that's such a pretty looking breakout, I'm like, oh, everybody's short. Everybody's short. Everybody's short. I know everybody's short. The retail market's short. I know the specs are short too. If you go look at CFTC data, what?
Yeah, Abdul's asking what would negate your euro bullishness?
Negating the breakdown. A close below 115. If we close below 115, it's a failed breakout. But while it's above 115, I wouldn't want to be short. And so anyway, I wrote that yesterday because it sounded kind of tongue in cheek, but it really wasn't. It was really, I can gauge what retail sentiment is by how people react to posts that I make. I post a lot of stuff on Twitter sarcastically because I'm trying to gauge what people are feeling, and you may or may not know that about me. I'll tell the people in our private chat room in ForexAnalytix that the people that are in this room, I'll say, hey, listen guys, I just posted this one thing on Twitter, and why did that not come up? Why is my chat room, why did it go blank like that? That was weird. When I move my screen. Here. Oh, there it was. Dang it. Okay. So anyway, when I'm in my when I'm in chat, I might tell people, I just tweeted this, but this is what I'm looking for, and I'm looking for reactions, from that, and because I can see a lot and learn a lot from the social behavior of people, how they react to things that I send out. Sometimes I'll send out charts. Amir, your mom would not approve. Okay, so anyway, but what I'm trying to point out here is that I'll do a lot of things on Twitter. I'll post certain charts. I'll even post things that sound bullish via the tweet, but I'm really bearish. But I'm gauging people's reactions, and it helps me because I know I have a big following, and I know my following is organic. I can really gauge what people are thinking as a result. So anyway, just some food for thought. But I'm gonna pass. Now that I've talked way on and on and on and more on and on and on than I probably should have.
You can go on.
No, I'll let you cover some of the other opportunities that have really presented themselves, especially, following the Bank of Canada yesterday and with the cable. And I know there's, Stelios always has something to say about the UK Brexit situation. So I'm gonna pass it over to you guys, but I'm gonna say this, that as long as we remain above 115 in the euro dollar, I don't think there's any reason to be on the short side.
I want to leave you on this high note, Blake, from Susan Taylor. I just want to say that in the short time I've been a subscriber, I've learned loads. That's from Susan Taylor.
Oh, well, thanks, Susan. I'm glad to have you part of the community. I mean, we love to, you know, we goof around when the market's slow, but when it's serious and things are moving, we're in there really banging it out. And I have to, you know, tell you that everybody in that chat room is very respectful of one another, and we just share ideas, and we have fun. And you know, I spend more time with people on that chat room than I do with my own family, so they're like an extended family of mine. And many of those people I've been chatting with for well over a decade, some of them closer to 15 years. So anyway, thanks, and I want to pass it over to my colleague Steve and Stelios. And remember, don't forget, if you want to take advantage of being a ForexAnalytix subscriber, this is one of a couple of times throughout the course of the year that we offer an annual subscription discount and semi-annual subscription discount this steep. So make sure you take advantage of it, and it's only good till the 18th, so that's a week from tomorrow. So
yeah,
all right,
until next Friday.
What? A week from Friday, tomorrow.
Until next Friday, yes.
Till next Friday, okay. That's what I said, right?
Yeah, I know.
Okay, all right, just making sure I said that. All right, you guys have a great one. Thanks for being here, everybody, and thanks for tuning in today. Remember, for those of you that don't normally listen to us, we're here every single morning at the same time, same bat time, same bat channel.
Thanks, Blake.
See you later, Blake.
GL, Blake.
Thanks. Bye, guys.
Steve, before you start,
guys, before you get started, you know, we always have someone in face asking about the Nifty. I just want to let them know that I have at India charts at the top of the hour who's going to be covering the Nifty in depth. So, you know, all our face members that are active in the Nifty and the sub markets on it, stick around to hear Rohit Srivastava at the top of the hour. And just one more thing, like Blake was talking about hoping things, you know, it's one thing to hope that something gets to a level, but, you know, I was saying about hope and trading that hope is the oxygen of our life, and it's the carbon dioxide of our trading. So yeah, don't use it in your trading. Hope.
Yeah.
Okay. Use it in your life, but you know how I know?
Yeah, the problem with hope
tried
and optimism. Yeah, the problem with hope and optimism.
I've tried hope.
Is that they're exact opposite of what you need. What you need is a plan.
Yeah, there
right.
You go. Right.
What you need is a plan. You shouldn't be hoping for things. You should just have a plan and just, you know, follow it.
I hope this one works.
All right. Steve, before you start, I have the latest installment of the Brexit circus. We had another vote that Theresa May lost yesterday, which basically will force her to present within a few days, I think within 3 days, if I'm not mistaken, what exactly the plan is if she loses the vote on the Brexit deal next week. Remember, it's planned for the 15th of January, Tuesday. So that's something that she lost, and she will have to move pretty quickly to show what she plans to do if she loses the vote.
She has no idea. I can tell you in advance.
Well, I was saying it in the chat room today. I give up on politicians. It's like it seems like they're doing it. Either they're very, very smart, or it's all in random. So
none of them. I mean, none of them. And if you remember, I said that a long time ago. Even the ones, I mean, even the Labour Party, they know what they don't like. They have no idea of, you know, they don't have any proposal that would have a decent chance of passing either the approval of the European Union or the approval of the vast majority, or at least the majority of UK citizens. So in my opinion, it's a dead end, Stelio. I mean, there is no chance that they're going to end up with an agreement that, you know, will both get approved from the European Union and get the approval of most of the British people. So, yeah, I don't know what's going to happen really.
I don't know either, and it seems like a complete mess. And the interesting thing is that yesterday we had the first leader of one of the European Union countries to suggest, the Austrian Chancellor, to suggest that there could be an extension to the deadline, and this. So, we're getting so close to March now that it's starting to get very pressing. And if people think that there is some kind of hope for some deal, I mean, I really don't know what they can come up with, but there might be an extension. You never know. It's going to be until the last minute. So
nothing would surprise me. I mean, an extension definitely wouldn't surprise me. It would buy them more time. Now, is that a good thing or a bad thing? In my opinion, it's a bad thing. And why is it a bad thing?
Uncertainty.
It's not only the obvious, which you just stated, uncertainty, but what would change? Let's say they get they get an extension. Okay, so what is exactly going to change? I mean, what kind of a problem that they currently face in settling with a deal is going to go away just because they bought more time? None of it, right? So getting an extension is going to be a relief in the short term for the politicians, because they will not be pressured to to come up with something right away. But on the other hand, does it really solve any problems? Does it make any decision easier? No, it doesn't. So it's just kicking the the can down the road, which, as you implied before, it's what politicians know how to do best anyhow. So that's why it wouldn't really surprise me.
Yeah, let's see what happens.
Yeah. Okay, anything else outside the UK?
We had these ECB minutes. There was nothing really to note. So apart from that, nothing new, I'm afraid.
Okay, cool. Now, since the Nifty was mentioned, I'm just going to spend a few seconds. The move higher looks corrective. Another leg lower looks likely. 10,000 is nice support, but at the same time, somebody can see it as the neckline of a head and shoulders formation. You can see it here. So obviously, if we go down to 10,000, that's going to be like a huge level for the bulls to defend. Now, the chances of us going to new highs from here, seeing the price action, not high, I would say. It looks very likely that the next move is lower. Okay. Now, having to do with the S&P, we made it to 2,600. That's a very nice level. I've kept accumulating position here. I actually barely got triggered on my third part, overnight. So, we might move lower from here. It's a good place, but we might even push a little bit higher. I mean, I wouldn't be surprised to see 2630 print, which is also a level of interest. So I do still think that the chances are that we're going to get more weakness. Now, as I said, that doesn't mean it will happen from here. We have some room to move higher. You see the Nasdaq as well. An important trend line resistance is a little bit higher. Russell, we have, we sliced through this resistance, but we have, more important resistance coming at 145.30. So, I would be very, very, very cautious here. Okay. Now the DAX has given us a nice rebound. The FTSE has given us a nice rebound, both of them from possible descending wedges. But probably not enough to declare that something huge has happened here. Same with the Nikkei. Nikkei has rebounded, but the rebounded Nikkei seems very tepid. You can even interpret this as a bull flag, as a bear flag. As you see, we found support at the 100% extension of the first leg lower, and as you see, previous support resistance area. So we had indicated that as a support level. We tagged it. We've rebounded from there, but in all honesty, the rebound doesn't seem impulsive in any kind of way, and that bodes well with how the USD yen looks like, because in all honesty, this rebound looks quite weak. I mean, if we exclude this big week that we left behind in that flash crash that we had, I think that the USD yen looks vulnerable, and I think at least another move lower towards 1.550, not in a flash crash mode. I mean, in a regular fashion, seems quite a probable scenario. Now, of course, we can rebound a little bit further before seeing here as well, because we might get, alternatively, we might get something like this. here, right? So it's not 100% sure. I mean, this is quite an important area, the 108 area. So, if we rebound from here, I think that we might make it even all the way up to 110 before seeing more weakness. Now, if we fail from here, we can go straight down towards 1550. So, stock indices, yen, all look vulnerable either from here or after one more push to the upside. Now, having to do with the Euro USD, Blake covered it fully, so there's nothing to add here. I would be more inclined, though, from a personal perspective, to be looking higher in pairs like the Aussie and the Kiwi. I like the way that through that flash crash, they satisfied like one more low, and now they're rebounding higher. I think there's more strength here. We've seen commodity currencies overperform. Kiwi yesterday closed above this descending channel, so I think this opens the door for more strength, probably towards the 61.8 of the last leg lower, which comes at the 70.5 cents area. Also, as you see, previous support resistance area. So I do think that Kiwi and Aussie look quite healthy. Undoubtedly, also the USD CAD and the USD NOK look nice, especially the USD CAD, as you see. I do think that after such a move lower, such an impulsive move lower, which is what we expected, to be honest, I expected that after a move lower, we might have found support higher. But the impulsive nature of the move lower makes me, now let's delete that because it has already transpired, makes me think that whatever rebound we're going to get at some point from here or from a little bit lower from the 61.8, the first rebound should be a good opportunity to sell for another leg lower. So I do think that since the first leg lower is strong, even if this proves to be a corrective move, it might lead quite lower, perhaps even towards the support of this ascending channel, because as you see, there is a bigger ascending channel. You can see it here with blue color. So we might make it all the way down there. So I do think that the USD CAD is in sell the rally mode for at least one more leg lower. USD NOK more or less the same, although I would caution a little bit because this is what we drew a long time ago. I expected another push higher towards this confluence of resistances, then a rejection. All that has already happened, and then perhaps finding support in this long-term broken channel and moving higher. So we are exactly at that point now. I mean, we're retesting this broken channel's resistance as support. So I would really be interested to see if we're going to get some kind of a reaction from that area and what kind of a reaction that would be. I have to say, though, that there is also the bearish case scenario here, which is that we might see. Let me draw it. We might see some kind of a reaction back towards this zone, right? Previous support resistance zone, and then lower again, in which case we're going to have head and shoulders formation here, right? With the neckline being the previous channel's resistance. This time it's going to be support, and it's going to be the neckline of a head and shoulders formation. If that happens, then we're targeting lower levels. We will then measure the height of this formation and extend it from the neckline to see where it's going to take us. Just simply eyeballing it, it's going to be below 8, right? Might be somewhere here. So I think that we're currently testing important support. This might lead to a bounce, but I want to see what kind of bounce that is, before I take any decision of if I want to do something with it and what that's going to be. Now, we had a conversation previously in the chat room about the SEK. The SEK is obviously much, much weaker than the rest of the currencies we saw against the US dollar. So I said it a few days ago as well. If you want to be short the dollar, the SEK is probably not a choice you want to make, because seeing the dollar weaken so much, but the USD SEK barely, being off the highs, is not a good sign. Probably it means that if you want to play the USD weakness, you should choose something else, as a counter currency, right? Now, having covered that, let me also see USD Swiss. Yeah, we have a question about the USD Swiss. Listen, I have to say, I said that I'm not going to cover the Euro USD because, Blake was quite clear about it. But I have to say something here, and it is, of course, by breaking above this area, we open potentially even the room for another move higher towards the 118.30. What I don't like that much about the Euro USD is the fact that, especially if you have a look at the USD Swiss, which they're inversely correlated, the move lower definitely doesn't look impulsive to me, right? In fact, as you see today, we're rebounding from this descending channels support. So, any way you slice it, the move lower in the USD Swiss looks to be corrective, and the chart tells me that at some point we're going to get another move higher. That's why I would be very, very skeptical about being long the Euro USD, and that's why I started by saying that sure you can be long the Euro USD, and the Euro USD has indeed given us some type of a breakout here. But would I pick Euro to be long against the USD versus something else? Probably not. I think the commodity currencies look, much better at the moment against the US dollar. So, I would be a lot more skeptical. Needless to say that the pound looks even worse. I mean, the pound is in essence recovering, in a very slow manner, and it's back in this 128 support resistance zone. So, in all honesty, I would just, stay away from it because we've seen it multiple times. The pound can just, plunge lower just because of a headline or, some kind of an announcement or whatever. Of course, it can do the opposite as well, right? And it can start squeezing people, absolutely, because the market is overall extremely short the pound. But in order for the market to start getting squeezed, you first need to see some kind of a violent move to the upside. And once that happens, I think that there is going to be a fine opportunity to be long, because just by positions squaring off, you should see quite a nice extension. So I think instead of trying to be long in advance, hoping for something like that, you'd better first wait to see that type of a move and then ride along. That's why I feel quite confident still being short the pound Aussie, and it's doing quite fine. Today, on a daily closing basis, we might even see a daily close below this ascending channel that you can see here on the daily chart. On the 4-hour chart, so far we're seeing quite a nice candle if you're looking for some kind of a rebound, because this was looking quite a nasty candle, but we seem to be recovering, so we might see some type of rebound from here, but still I think there is more room to the downside, perhaps towards the 61.8. So I'm still looking good with my position. I've now anyhow traded my stop loss slightly in my profits, so I'm going to hold on to it. Pound Kiwi, on the only thing that makes me, and that's why I wanted to talk about the Pound Kiwi and about the Euro Kiwi, the only thing that makes me a little bit cautious is that Pound Kiwi, the move in Pound Kiwi looks quite corrective, so it has completely different characteristics than the Pound Aussie has at the moment. So if I purely looked at this chart, I would say that that it has a good chance of breaking the upside. And the same applies with Euro Aussie and Euro Kiwi. If you have a look at the Euro Aussie, we didn't know what type of a move we would have here. Perhaps this is some type of an expanding triangle. Who knows? We need more price action to be able to tell. Might be a flag or whatever. So the Euro Aussie has multiple interpretations that look decently bearish for the time being. But if you look at the Euro Kiwi, on the other hand, Euro Kiwi consolidating near the highs. So a totally different thing here. So it looks like on those charts that the Aussie might continue overperforming in the short term against the Kiwi. And another reason to be cautious is because if you have a look at the Aussie Kiwi, we had a very nice breakdown. You can see it here from a very long-term symmetrical triangle. and we retested it. So far we failed, but if we do make it back above there, and given the fact that we had this, might not be very visible, but we had this flash crash in the Aussie causing this week here. So in essence, we satisfied the expectation that after a break below the triangle, you might see one more push to the downside. Although ideally, I would want to see a push lower from the lows here at parity. If we see it break above this trend line once again, we might see an extension. Why? Because there are probably a lot of stop losses here. So we might see even a deeper pullback before seeing lower prices, right? In this case, Aussie might continue overperforming in the short term against the Kiwi. That's why perhaps we see this divergence between Euro Aussie and Pound Aussie and Euro Kiwi and Pound Kiwi. Euro USD may be in ending diagonal, and if so, USD will be very strong. Yes, that can be the case. And to be honest, if we have a look at the DXY, the DXY's move lower. It has definitely accelerated, but so far, have we really done any big technical damage? No, not really. We're currently actually about to test this confluence of supports, horizontal support area, and the 200 daily moving average. As you see, it's converging. It's actually entering that zone now. So I think we can extend to the downside towards at least 2260, 2270. But we first need to clear this 95 area, right? So 95 is quite an important support. If we do clear that, then we can extend lower towards 90 to 70. But I first want to see what's going to happen in this area, right? I mean, we had said that once the DXY clears the 9620 zone, then it's going to have more room to run to the downside, and that happened because once we clear the 9620 area, we actually move towards the the next support zone, which is here. But now I want to see this support zone being taken out in order to expect another extension to the downside. Because yes, so far this move to the downside isn't that convincing, right? Because there are several bullish interpretations as well in the medium term. So despite me having a long-term bearish thesis having to do with the USD, that doesn't change anything in how it looks in the short term. And in the short term, it's not broken yet, right? Now, metals are still consolidating, so nothing changed since what we saw yesterday. But the fact that they're consolidating near the highs, we yesterday had a look at the 4-hour chart, and it was even more clear. We can have a look at it again. Here is silver, and probably a bull flag or something, and here's gold, probably either a triangle or a rectangle, or perhaps a triangle which we've already broken out from. So we might come back, retest it, and then push higher once again. Bottom line, as long as, for example, in gold, we remain in the daily closing basis above 1278, I think there is a good potential for another push higher towards perhaps the 161.8% extension at 1312, right? So I would be very, very skeptical in being short metals here. Same here with silver. We seem to be consolidating near the highs. So as long as we remain above 1550, I think that another push higher, perhaps even towards 1620, is likely in the cards. So I would be quite careful, because this looks like just like a pullback for the time being. So let me see if we have any questions that I haven't covered before I go on. What negate your USD bullishness? Blake already answered that. So anyhow, it was referred to Blake.
Back under 115, Blake said. Negating the breakout. Negating the breakout.
A daily close below 115, yeah. Although, to be honest, for me, although I'm less bullish the euro than Blake, a lot less, I would have to say, but that, you know, for me, the key zone here was on a daily closing basis, this 114.50 area. So I wouldn't be as strict as he is. For me, 114.50, 114.60 probably would be, you know, a more solid zone to negate, you know, the breakout, right?
All right, you're less bullish. Does that mean, Steve, that you think this pullback in Dixie maybe only has legs to 94 or so, and then we could resume for one more up move in the dollar and pullback in metals?
Yeah.
Is that kind of what you're thinking in the background? I know it's not actionable, but we all have thoughts.
I think that so far we don't have a strong indication that the dollar has really rolled over. I mean,
wasn't this impulsive the last few days? Did it look impulsive to you?
No, we had, first of all, let's not forget that even corrective waves have smaller motive waves in them, right?
Okay, so, yeah, right. Yeah. I don't know.
Yeah, so
I guess at Elliott whenever I talk about. Don't believe anything I say about Elliott, guys.
So yeah, it's actually, I didn't realize it's 1 minute past. So is your guest here?
Yes, and you know what? He's going to talk about the Nifty.
Okay, perfect. Let's see if you know, he sees the same thing I do. I see a corrective bounce here, so I would expect at least one more leg to the downside in the Nifty.
Okay.
From a technical perspective, it looks quite clearly as a corrective bounce to me.
Well, I don't want to steal his thunder, but he put out a nice tweet. I think he was looking for some type of right shoulder, but I'm gonna
that's what I said before, actually.
Oh, really?
You know, if we go down, if we push lower once again, and we go down to 10,000, then you have a beautiful head and shoulders formation, and then you know, 10,000 then becomes the line. And the line in the sand for bulls. And
okay, you know, Rohit, you don't have to talk to us today. Just kidding, buddy.
Yep, that's it. Thank you for joining us.
All right, Naresh Jain. We have a lot of people, obviously, maybe your countrymen that trade the Nifty the way we trade S&Ps and the Dow here. So thank you so much, Rohit. I'm making you the presenter, Rohit Srivastava. At India Charts, welcome back to Face.
Hi, Dale. This is Rohit here.
How are you, buddy? Thank you so much.
I'm good. Thank you.
Thank you for not holding anything against me in the last interview and returning.
No.
So, you know, we have a lot of nifty traders that come into our free webinar here in Face. So looks like you have a PowerPoint to show us. So great.
So I have my charting software if we really need to get into it. But I'll start with the PPT because I've put on half a dozen charts there that will take you from the long term to the short term on the Nifty. And then we can, you know, break it from there forward.
Okay, well, I'm just going to, you know, I'm not going to go through how you got started because we've covered that, and market action since we last talked has really shifted, right? I mean, we talked before the big downdraft in the U.S. In, you know, beginning in October and accelerating in December. Before we get to the technicals, I have one fundamental question, and I know it's, you know, no answer is right, but I'm curious. What has changed geopolitically has been this trade war between China and the U.S. How has that affected India? Is it a benefit to India because perhaps China becomes more reliant on India as a trading partner, or does it hurt India as China weakens from this trade war?
I think it's a rather tough question because so far we have, I've really not seen anyone delve into that angle pretty deeply. Most people would think that we remain unaffected by what is happening. but I doubt that is the case, and we'll only be able to judge that after we know what the actual actions are on the trade war front. So far only we've seen import duties come up. I don't think that's really had a material impact, except for really moving prices of commodities.
Okay, that's fair. So let's start, buddy. Let's take a look at some pictures here. Pictures speaks 1,000 words. You're an excellent technician, and looking forward to your views.
Thank you. So let me start with what is the longest chart, because we have maximum history for the Indian index called the Sensex. And then I'll come to the Nifty, simply because when you do Elliott wave analysis, you need a lot of history to make your point. And so this chart dates back to 1978. From that's where the Indian Sensex was started or created by the Bombay Stock Exchange. And this index, in my sense, has been in its fifth wave. You will remember in my last presentation, I showed the Nifty 500 to display that this ending pattern was pretty much apparent, and I will come to that chart. The point here is that we are, ending a very, very long-term 5-wave advance in our market that has been, going on for several decades. And my sense is that this ending pattern marks the last and final phase of that, which is why I've also written about the Indian economic winter, where I compare the economic data with this Elliott wave structure. So moving to the
all things must end, right? All things have a beginning and an ending.
That's right.
There's a season for everything, and you're talking that potentially we're headed into winter.
That's right. So the Indian market has been facing the beginnings of the winter cycle. And that usually follows a boom in consumption. So consumption has been the hottest sector in India for the last 5 to 8 years. And at the same time, simultaneously, we've been developing our own debt problems, because we have rising non-performing assets in the banking sector, which have been heavily debated in the parliament, as well as to how you fund it. And more recently, the non-banking or shadow banking sector has started to show up, losses, and they're trying to provide liquidity to that. So slowly moving very clearly into that cycle, just like we should. But coming to the chart and how the Elliott wave patterns showed it is, I was anticipating a fifth wave from 2010-11 when I started writing these winter reports. And this fifth wave has stretched on for 5 years, developing into what is an ending pattern, which Elliotticians recognize as an ending diagonal in a fifth wave. And my sense is every rally since 2009 in the Indian market has been a series of 3 waves, as I've shown on this chart, including the most recent rise. So I think the last time we did an interview, the Nifty 500 was somewhere around this point. So it had made this top in January. And here we were pulling back in May, June, trying to pierce the top end. We finally made one more attempt at the top end, doing a throwover again, and then
have to shake those shorts out first from Y that thought they had the top. Mr.
Sorry?
Market, they had to shake the shorts out that thought they had the top at Y on the pullback to X, and then we had E, and then boom, yeah.
Absolutely. So we've seen some of the maximum short positions in retail get squeezed over there. A huge amount of put writing and open interest that essentially reflects what you're saying, a short squeeze. So that happened all through this period. And eventually we've now sold off from the top end of the wedge and are testing the lower end. So we found support at the lower end of the wedge. I'm marking this as the first wave of the bear market, and the second wave is what we've been progressing through over the last 2 months. And it's been a slow and painful period. So a lot of traders have started to debate, and we'll look at why. So now I'm going to the weekly chart. The weekly chart shows that we could be developing a right shoulder, just as you were discussing earlier. And this chart actually shows only Nifty volumes, which means the Nifty 50, which is why you see a lot of volume on the right shoulder, which is not be normal with the right shoulder pattern. But if you put market-wide volume, then the highest volumes were on, at the left shoulder and into the head. And we have reduced volume on the right shoulder when we take the market-wide volume. So my sense is the 61% mark, which is at 11,100, is like the cutoff point for thinking alternatively. So far, we've not been able to get that far. We've made a high of 10,985. And we've made 2 impulsive declines from there. So I think we are in the early stages of rolling over from this right shoulder into the neckline and probably lower. Now, if I simply go do an ABC, then probably it would project to 9,300, which is also closer to the monthly averages. But if we do a normal head projection, then it would go as far as 8,500, which would probably look like a major crash in the Indian markets if that really happens.
Would that be like a fib extension from up there of 1.618 that measures the same level? Okay. So you have confluence of a fib extension and a head and shoulders formation. And that's a pearl, Rohit, about that's something I didn't know. I've been doing this a long time, that I should be looking for lower volume on the right shoulder. So thanks for mentoring me today.
Right. So I've even found very often that when we do the HNS, the third wave down for the HNS target does end up matching the 161% projection, like you mentioned. So that more often ends up being the case. And so now I'm delving into the breakup of the entire decline we've seen from the August top. We had a 5-wave decline, and then we have this right shoulder, which has developed again a rare pattern.
Is that a diamond?
That's a diamond, a very, very rare pattern to see.
Okay.
So it took its own while, because initially it looked like an expanded flat that should have ended in the early part of December, but continued to form into multiple swings, which is now looking like a diamond formation. And a diamond formation, like any triangle, also we can fit with 5 waves, which is what I've tried to do. But we've started now getting that impulsive sell-off with an initial 1 and 2. And the top end of the triangle ended up being a resistance today. So today we've actually closed down. That's why you're seeing this red bar.
Okay.
And we've closed down from the top end of the triangle. And simultaneously, while this was happening, we also developed an intermarket divergence. Now, one of the other important indices in India is the Bank Nifty, representing the banking sector. And the Bank Nifty continued.
Go ahead.
Yeah. So the Bank Nifty continued to make one more new high into yesterday, even as the Nifty was unable to do so. So we have now 2 new highs in the Bank Nifty, not confirmed by the Nifty itself, and this intermarket divergence. Today, both the indices were in red, so they are maintained, and it continues to be one of the indications that we are in a topping process that may be almost complete.
You know, that's the opposite of here in the U.S., because the bank sector peaked before the overall market and led the decline. What do you think the reason is for your banking sector holding up better than the general market? Is it currency devaluation?
So that's a very good question, because the Bank Nifty in India actually has a very small number of stocks, which means not more than a dozen. And it does not represent a large part of the shadow banking, which is the NBFCs. It does not represent the public sector banks, which is where all the non-performing assets are. None of them are part of this index, and which is why it does not fully reflect the move in the banking sector.
Only the bluest to the blue.
Absolutely.
And if one starts to falter, they'll find a replacement.
Yes, that's right.
Like the
We've been doing that. We've been changing the components of the Nifty, and almost every other month for the last 2 years, 3 years.
Wow. Yeah, that's a lot of changes.
Yes,
all right. So as they try and stealthily tell us everything's okay, all your stuff is saying no, it isn't. So, okay.
Absolutely. So one of the statistics that I ran all through last year was how many stocks that are listed on the exchange, which are liquid, which are around 1,200 liquid stocks, how many of them are above or below the 200-day moving average. And right now it's around more than 70% of these stocks are below the 200-day moving average, which is what the market internals reflect, a much weaker market than what the index is really telling us.
Okay.
So here's now the mid-cap index. So this is the second line index, and you see a very, very different pattern than what we saw in the Nifty itself, because it represents the next 100 stocks and not the top 50 stocks. And this index peaked in January of last year versus Nifty, which peaked only in August, 8 to 9 months later on. So there too, we have a major intermarket divergence. And this chart shows a falling channel after we've already broken the upward trend line from 2013, and we are closer to the top end of that channel. And so my sense is we are due to start another wave down, this being the third, I think, lower top from the high that we made a year ago.
Great look.
Now, this is a closer look at the same mid-cap index. Each time it has been bouncing back to retrace close to around 61% of the previous sell-off. And right now it's just below the weekly 20 and weekly 40 averages. And last week, in fact, we got an engulfing bear candlestick pattern. So we'll be watching tomorrow on the weekly close as to whether that continues to be respected.
Okay.
Another way to look at it, earlier I talked about the 200-day average and number of stocks. Another plot that I do is the relative strength of the mid caps to the large caps. So that pretty much tells us the cycle of how the small stocks are performing. And many times prior to a major peak, we get a divergence between the indicator itself and the index. And we got that at the top of January last year, from where it has been declining. So we pretty much down for most of this year as far as stocks are concerned, even though the Nifty itself is still holding on to the range at the top end.
Okay.
So that's I think with that I've actually taken you through the Nifty on the daily down to the weekly charts. Now, if I really look at the hourly charts, I can see possible two series of impulse waves down, which I've marked as 1, 2, 3, 4, and 5. So this is wave 1, wave 2. We did an 80% retracement. Again, another 5-wave decline, and we've been making this noise over the last 2-3 days. And since we didn't break out of this top end, my sense is we should be starting the next wave down pretty much right away.
Okay. Thank you for using a telescope and a microscope.
So this is the weekly chart of the Nifty again. Here too, we have an engulfing bear candlestick pattern. We have a couple of them showing that there's strong resistance in this zone, and we've just not started off the next wave. We've also not been crossing past the weekly averages. So this is the 20-week average. We've made one attempt, second attempt, and a third attempt that we were not able to really get past that level. So I'll now move on to some of the other important indicators. One of them is the currency itself, which is the USD INR. Right. The USD INR has spent almost 2 years below the 69 level. In fact, I should say maybe 3 to 4 years, because in 2013 it made a high of 69 and was below that till 2018. And this year it has actually broken out of that range, and it has done so with what we call a breakaway gap. So you can see this gap here, which is at 69.40, and that gap remains unfilled. Over the last 1 week, it made an attempt to actually fill that, but it could not do so. And once again, we've moved up from there. My sense is this is the first wave of a new rally that we've started breaking out of that 4-5 year trading range into what is a long-term fifth wave. So this is just the first of the fifth wave, and we have pulled back in what is the second. And holding this breakaway gap, my sense is we are now starting, or on the verge of starting, or probably already started, the third wave of this advance. And a simple projection of equality of the third to the first would give us somewhere around the 82 rupee mark for the USD.
That's like another 30-40% evaluation of the rupee.
That's right. I think over the next 6 months that should be possible.
Oh my, yeah. Is that going to be? That's going to be considered a crisis. You guys have a new central bank guy after that resignation. You think that's his plan, or that's just the market moving against him?
It looks like a market move because we are ahead of Indian elections in the month of May, and they wanted to bring about a sense of stability. So it looks like it was.
So they do that by cutting the currency in half into the election. Again, everything's going to cost so much more for the general population if this happens.
I'm sure they don't want it to happen, but you'll be surprised that when the move above the 70 level actually started to take place, there was a comment from the finance ministry that we are actually happy to see the rupee at a 74-75 level because it might be good for exports and so on. So they started to put a positive spin around it, which means that they're not looking at supporting the currency at this moment. Yeah. And we do have dual pressure points, which is sometimes when oil prices are up, we are net importers. And at the other point, we've always had a trade deficit historically around 2% has been our current account deficit, and is around 2.4%, I think, this year. And so since we are net importers, the currency comes under pressure as and when there are no capital flows. So we are highly dependent on capital flows. And given the weak equity markets around the world, I think that's what we are not getting, which is we are not getting those capital flows right now.
See, I knew you were more than a technician. Okay, buddy, go ahead.
So yeah, so I think this is one of the progressions which is happening. We are getting a weaker currency. Another chart, and this one is important from the economic cycle perspective, and this is the Indian bond yields. The Indian bond yields had fallen all the way down to around 6.2% almost post demonetization, which we conducted in the year 2016. And from there on, the yields have been slowly rising for the last 2 years. And we've moved up above the 8% mark on our 10-year interest rate. And more recently, it has pulled back to around 7.2 and then started moving up again. My sense is this is an impulsive wave in wave C long term. So this is a multi-year chart. Okay. And I sense that by the end of our economic winter cycle, we would have probably completed wave C, and after that, we'll probably turn down. So I do see the bond yields moving higher from here initially to probably 8.9%. And on a breakout from there, then we would potentially go to the top end of the channel, which is at 10.4 to 11% in probably a throw above the lines.
This is a classic example of rates can go up, not because of economic strength, but because of capital flight. So if we're going to be right about where the rupee is going, India is going to have to pay people a lot more interest for them to take the risk of holding 10-year paper. Is that the correct interpretation?
Absolutely, that's right.
Okay, buddy. Everyone thinks rates only move up because of economic strength. I mean, that's what, we've been schooled. But rates can move up during a currency crisis. So, everyone in the world has to be aware of it because it's all fiat.
Yeah. So that's I think with that I'm done with looking at the Indian charts. A couple of other interesting charts since we discussed the head and shoulders on the Nifty. I think most global markets, including the DAX and the US market, have actually formed HNS patterns. This is, of course, the NASDAQ. I've wrongly spelled that. I haven't put the D. So the NASDAQ did break an HNS head and shoulder structure. And the most recent rally, if I draw the neckline, appears to have simply pulled back to it and is kissing that blue neckline right now. So my sense is it should probably stop there because it's already a 61% retracement of the sell-off, and we should start the next wave down, which could be part of a third wave and could see us go probably much lower. So that's what I'm looking at on the weekly chart of the NASDAQ.
Okay. Nice neckline. I hadn't seen that before. Okay, so what do you have? Dixie here? What's this?
So this is the S&P.
Oh, okay. Yeah.
Okay, so the S&P, I've just drawn a falling channel for the entire trend.
Right.
And so we're coming closer to the top end of the channel. And so year two, I think the top end of the channel, I would hope that it holds out. Unlike the first case where you developed a flat, which means you got an ABC pullback in wave two, this one so far looks like a zigzag, which would be fair given that it should be an alternation. I was hearing earlier you all were discussing the potential that it could develop a flat. So I was just wondering, if you have a channel, would you really spend so much time in a range, developing a flat? So that's something we would have to see.
Let me ask you, I could tell you're really very good with Elliott, and I'm not, I'm an amateur. But could this ABC, maybe it's ending here, we get a pullback, so, ABC for A up here, and then we get a B wave pullback, and then another ABC to complete C?
Right. So when you do an ABC, which is what we did in November and December, we did ABC up, we did ABC down, and then the C wave is usually 5 waves. So we did that here. The point is, while the same can be expected here, what Elliott does say is sometimes you get that it's not a rule, but it mostly happens is that subsequent waves have alternation, which means the same pattern does not repeat itself.
Okay.
And which is why, since we already did a 3-3-5 structure in the second wave, we would probably not do it again over here. That's the point I was trying to make. So while while it's possible, it's not expected.
All right, great. I learned from you again. The rule of alternations important in Elliott, and it's not in my vocabulary, but now it is. So, all right, S&P's failing. Let me ask you this: are those Boley bands that you have up on there?
Yes, those are.
Okay, where's that top red Boley band come in? Because I've seen many examples of a market breaking trend for a little while, and then trend line's destiny is to be broken, in my view, and then fail. So I was just wondering where that line comes in. 2678.
Yes, 2678.
Okay, thank you.
Yeah, so the first level I typically watch is the 40 exponential average, which is right now at 2600. Right. Mm-hmm. So I guess if it does go above 2600, there would be odds of it getting that far to the Bollinger Band. But we've seen that happen. I think if you look at the maybe the Russell, it's probably pushed above the 40-day. There is some room that it can pull up to the Bollinger Band. So that's something we can watch out for till it actually turns down. It's still open to stretch a bit more. Yeah, but the channels were directing me that, when I drew channels, that maybe the upside could get limited by the channels. That is what I was trying to think about.
All right. Yeah, there's always multiple possibilities, so I just thought that might be a possibility too. So what's next, Rohit?
So I'm moving on to gold. Yeah, I'm moving on to gold. Gold, my sense is it has rallied up to around 66% of the sell-off that we saw in the last quarter of 2018. While it's possible it goes up to this blue line, I am sensing that it could pull back based on what the dollar might end up doing. So, of course, we can come to the dollar later, but so I'm sensing that maybe gold pulls back once more to the lower end of this range, which is closer to the 1200 mark, before it really takes off into new price territory. At the same time, very, very long term, I think 2015 was the bottom. I don't think that low will break because of the ending pattern that developed between 2013 and 2015. And my sense is that that level ends up holding longer term. But within this range, we've spent now almost a couple of years consolidating between 1200 and 1360, 1380. And that consolidation may or may not be complete. So I'm just sensing one more leg down before it really starts to break up on the upside and start a major rally that probably a lot of people have been trying to anticipate.
Okay.
The other interesting chart is we've seen a rally in the US 10-year, 2-year bond market. This is, of course, the price of the bonds, not the yields. And most of them, the 2-year and the 5-year, all have rallied to the top end of their channels. So the recent high is exactly at the channel point. So I've been considering whether this move is complete and we start another wave down for the bond market. In the 2-year and 5-year, it will look like a fifth wave, as I've shown on this chart. So once we complete 5 waves, only then we could probably get a more meaningful move on the upside. But right now, probably we could be looking at much lower levels for bond prices in the weeks ahead.
So that would take out this is the 2 and 5s that we're looking at, or the 10-year note?
No, this is the 5-year itself.
5-year, okay. So if this happens, 10-year will take out 3 1/4, and maybe head towards 4% on this count.
That's right.
Okay, buddy. Nice view.
Now, this is just a chart I put together to map the long-term economic cycle with Elliott waves. The way I've seen it develop in the US market over the last century, and then I could see a similar pattern in the Indian market, is that waves 1, 2, 3 is where the spring wave, the spring economic spring takes place, which is the birth of the economy and the expansion of the economy. And the economic summer is essentially the fourth wave, which also comes along with high interest rates and inflation, something that you saw in the 70s in the US, and we saw something very similar in India in the 1990s, very high rates of inflation and interest rates. And at the end of that, once interest rates and inflation come down, we have an economic boom on the back of low interest rates, which is what has continued till date. And after that, you have the economic winter. So this was just a mapping of that cycle. For anyone who's very interested in understanding all these stages, I think this chart is from Ian Gordon's website, Long Wave Group, and he has a detailed presentation on each of these, each part of, and it's a free presentation for each, explaining each section and what happens during each section. So anybody who really wants to get into understanding the counter-type cycle, I would direct them there to really, look at those presentations. They're really in depth and interesting.
Okay. Yeah, I like that Kondratyov stuff. So. Okay,
I think the last thing I'll do is probably go to the dollar index, and that should complete my discussion. I think it's probably the most important because everyone's watching what the dollar is going to do and how it's going to impact commodity prices. And more recently, we've seen a sell-off in commodities, which would have been indicative that we are still in a strong dollar environment, but the dollar is actually sold off even while commodity prices are down, which has come as a slight surprise. So at this point, we were almost at the 61% retracement mark on the DXY, and I did think that this is sufficient. Also, my long-term view was that we've actually topped out here longer term, and we started a wave down. So I was marking this as A, and I've been marking this rise as B. The question is B over? And B would have three waves. So I have subdivisions, wave A, wave B, and the question is wave C complete? Or is this only wave 1 and 2 of C? So I think that I don't have a conclusion to this. I'm still being watchful as to this can be 2, because if it is, then we might still have 3, 4, and 5 pending before the bear market in the dollar really resumes. So the question is it starting from here, or is it going to do 3, 4, 5? I think the next couple of days should probably give clear-cut clues as to that. So that's what I'm watching for.
Well, with your bearish count on a lot of the indexes and everything, I'm thinking what could be a potential catalyst for another run up in the dollar, and that could be it. Maybe, the washout wave in equities and just a flight to safety, and that's people come back to the dollar during that time frame. What do you think?
Yes, that sounds like it as of this moment, because equities are looking weak, and that could be the reason. And also the commodities are looking weak. So if both of them are weak, logically, the dollar should have moved up, or should move up, maybe with equities at least. But it's definitely surprised that you had a sell-off in commodity prices, in oil, in copper, but not really a move up in the dollar. So that's where you start wondering as to whether C is complete. But I think the odds are open, and we should just watch for some more time for further clues on that.
Okay, Rohit, why don't you show your website so people know, after hearing this great presentation, how they could keep in touch with you. They can follow you on Twitter at India Charts, and this is your website.
That's right, indiacharts.com. Anyone can come here. There are a lot of free posts that I put out every day. And if you're looking at getting the daily updates, you can simply go to subscribe to IC and subscribe here. It's priced extremely at attractive rates. It's like around $10 a month. In rupee terms, it comes to around 700 rupees a month. And I write a note on the Nifty almost every day and every week. And then I have a monthly forecast report, and then I cover all commodities, currencies, and equity markets as well. As you can see, these are the latest updates from the last couple of days.
I see that headline, get 4 commodities ripe for opportunity. Are you bullish agricultural commodities long term?
Yes, I am seeing a bottoming phase in agricultural commodities, though it's been very, very slow.
Right.
But I do see that happening.
Okay. You can't eat gold, right? Not without going to the dentist and him putting it in your teeth. So anyway, Rohit, thank you so much for updating us on what has transpired between our last interview, and I wish you a great 2019, you and all your subscribers, and let's get back in touch later on in the spring or early summer to see how things have evolved, and good hunting, my trading warrior brother.
Love to, and thank you so much for having me, Dale.
Great interview and excellent ideas, and thank you for mentoring me today, Rohit. Good hunting, and thank you again for being here. The video will be published in a few hours.
Sure, thanks a lot.
Okay, that's Rohit at India Charts. Great follow, in my opinion. Everyone, that's a wrap. Crewed under a little bit of pressure here. I'll see you tomorrow. Tomorrow we have Boris Schlossberg that's going to be our guest, and Boris has gone through a paradigm shift. I'll tweet about it. In the meantime, don't just count your pips, count your blessings. Adios. See everyone tomorrow. Thanks again, buddy.